In this episode, we're going to be looking at volume and open interest. A couple of the objectives that we're going to be looking at include the ability to understand trends through volume confirmation and divergence. The second of which looks at how to filter and interpret extreme volume. And the final objective for this video looks at measuring participation via tick volume and open interest. So, volume is the number of shares or contracts that were traded in a given time period. So while price bars show the price levels that a security was trading in a period of time, volume shows how much was traded in that period. So it represents the levels of commitment behind market moves. And this is because you can see the levels of participation amongst investors. Volume is usually displayed as vertical columns or lines below price data, just like this in the chart here. Volume can be used to confirm or warn of weakness in a move in price. Volume confirmation is when volume is rising. It's saying that more and more investors are getting involved with the move and more capital is being committed to it. An increasing number of market participants are interested in seeing prices continue in the direction that they're going in. So a continuation in this case would be expected. On the contrary though, declining volume represents volume divergence. It shows market participants are becoming less interested in the trend. It's running out of capital commitment to fuel it, so a reversal of the trend is likely to occur. So we've got a table here on the screen, and that shows the possible relationships between price and volume. So when price and volume are both rising, as shown here, price is rising, volume is rising, the outlook is generally bullish, as investors are committing to seeing prices go higher. And if the price is rising but the volume is declining, which is shown underneath this point here, we've got the price is rising and the volume is declining. Investors in this case are losing interest in the uptrend. So the uptrend is likely to be running out of steam. So the outlook then would be bearish. When price is declining but volume is rising, we've got a bearish situation. And this is because the volume is confirming a downtrend. So in this case, investors are committing capital to the downside, and the outlook is therefore bearish. Now with declining price and falling volume, which is this bottom area, we can see that volume is falling, declining, price is also occurring. And that shows that the downtrend is losing momentum, and so a reversal is likely, which means it is bullish. And you've got to notice that rising volume can be both bullish and bearish depending on what the price is doing. Therefore, volume doesn't give a bullish or bearish indication by itself. It has to be considered in the context of price action. We've also got to note that rising and falling volume isn't required for a trend to form. You can get trending price action on flat volume, but more often than not, you'll see volume confirming price action through most of the trend, and it will start to show weakness in the trend towards the end. Here's a good example of volume confirming a trend. So in this case, we've got an uptrend taking up most of the chart, and this is the chart of Walt Disney, the company. So this swing, or should we say the full pattern, was made up of 7 swings. We've divided the trend into those 7 swings, as you can see, 1, 2, 3, and all the way to 7. We can compare price in this case. The relationship here is shown by price, and here we can see the volume bars. And then we can compare each of the two for each stage of the trend. So let's look at the first swing here. We've got a good rise in price, which is accompanied by a rise in volume. That volume here is confirming a bullish move, and you can see that more investors are entering the market in this case. You can also see that they're interested in buying, even at the higher prices here. You can see around $95 here versus above 100 here. The volume is much higher, which is interesting. So that's a sign that the larger trend of the move is up. Now, if we go to the second trend, or second swing rather, we get a retracement in price and also a decline in volume. In this case, that means the selling is drying up and you're just getting a healthy retracement in a larger uptrend. So in this case, you'd expect the price to pop up once the volume declines entirely. And if we look at the third swing, we can see that the price starts rising again, the selling dried up, the volume here in an overall trend is rising. So investors would start coming back into the market, interested in seeing prices going higher still. So the larger trend is still up. If we go to the fourth swing, lower prices and lower volume, the declining volume here indicates that it's not the beginning of a new downtrend, but rather just a temporary interruption of the uptrend. If we look at investors here and think of what they would be doing, they're probably interested in further upside. So they would start to buy once that selling pressure dries up. So we can see in the fifth swing, prices rise again, and the upside move is confirmed by rising volume. In swing 6, lower prices, declining volume. Interesting. There is very little interest here in seeing prices go lower. So the larger trend is still up. And in the final swing here that is shown from our areas that we've divided, we have another short rise in price on rising volume. So at every stage of that uptrend, the trend was confirmed by volume. You could tell that the downside retracements were just minor pullbacks because of the declining volume, and they presented good opportunities to buy. So if we look after swing 7, the market starts moving sideways in a horizontal consolidation, and at the same time the volume here is quite flat. This is an important thing to look at because it shows a change in market behavior. We no longer have a price that is trending, and volume is not confirming a trend in either direction. That's telling here that the trend ended after the 7th swing here. So from there, the conditions changed. And subsequently after that, price starts declining sharply on rising volume. That's the first time that this has occurred in this entire chart that we have in front of us. So it's now confirming a downtrend. That is bearish, and it is a change from all the previous bullish behavior. Another use of volume is filtering for extreme volume, which often acts as a useful notifier of reversals in price. Extreme volume will often help in identifying buying and selling climaxes, which can end with very abrupt price reversals. Extreme volume can be filtered either via visual inspection or with numerical or statistical overlays. So we're going to give an example here with filtering via visual inspection, and this involves looking at the chart and using your own judgment to identify the threshold in volume that most accurately warns of reversal. In this example, the extreme volume threshold, shown by the red horizontal line here that goes all the way across, was drawn to mark the highest volume, and that was the highest volume bar towards the left of the chart, which coincided with the reversal. We can see here, this spike in volume, we had a reversal, and price went from going lower to going higher. Every time that the volume hit or exceeded that threshold after, that coincided with a high or a low in price and presented a viable trading opportunity, seemed to be a level that we would highlight. As you can see here, we've got a highlight above this level. That's a reversal area. One could use it as a trading opportunity. Here, above that level, which counts, so we can see reversal. Once again, trading opportunity, this time on the short side. Here, we have at that level, we have a trading opportunity on the long side, a reversal to the upside. And in the final area, we have a trading opportunity to the upside, a reversal from lows, an exhaustion below, and the price starts to reverse towards the upside. The other way to filter for extreme volume is to use statistical overlays, as we have here, shown by some interesting bits of lines and pricing data here, and also volume data. So here we're using a 2 sigma volatility filter. So what that means is the green line here, moving above the volume bars, is marking 2 standard deviations away from the mean volume. So you can see that when the volume exceeds this numerical threshold, it coincides with reversals in price with a good degree of accuracy. And the easiest way to apply statistical overlay like this is to put Bollinger Bands. And those Bollinger Bands can be put onto volume, not onto price. In this case, because we're only looking for extremely high levels of volume, the central and lower bands were disabled. So we literally only have this point here, which starts to help us understand whether we can statistically filter such extreme volume events. We can see a reversal here, anything shown by these blue vertical bars we can see shows a potential opportunity to trade based off 1-2 sigma filter. So, standard volume bars are by far the most common way of monitoring market participation, but there are other ways that we could be aware of, and one of which is shown here, another we'll be looking at afterwards. So, tick volume is here, and this is very similar to volume in the way that it measures the number of transactions, which is the thing that makes it different, rather than the number of contracts that are traded. So, with tick volume, a transaction worth £100 would be counted just the same as a transaction worth 100 million, because it's about transaction size, rather transaction volume than the total size that is traded. So, it tracks how many transactions actually happen, irrespective of transaction size. It's often substituted in FX markets, where standard volume data is not available. Also, in futures and options markets, open interest, the other thing we wanted to talk about, is the number of outstanding contracts in circulation. So it tracks how many contracts are currently active or haven't been closed yet. Both tick volume and open interest show levels of market participation and as such can be interpreted in exactly the same way as volume. So to conclude, volume data gives you access to another dimension in market analysis that you can't see from price data alone. It also gives valuable insights into what is fueling current market action and speculation and can be used to identify trend or weakness in trends. You can also use extreme volume filters to recognize high volume buying and selling climaxes. Knowing how to use these volume indicators is an excellent addition to the tool belt of any technical analyst.